So if you're trying to keep your wealth, if you're trying to save your wealth, save your money, or if you're trying to grow your money over a period of time, two things you need to account for. There's also other things like taxes and stuff. There's many things. There's a few things that will take away from your money. No matter what you do, it will take away from your money, and these things are taxes, inflation, expenses. But these three things you can't avoid. In this video, I'm going to be talking about inflation and interest. So inflation and interest are directly proportional to one another. I'm going to explain both. So first of all, inflation, you have inflation is basically inflation basically erodes or takes away the value of your money. How does this happen? So the government, the central bank, which is run by the government of a country, basically determines each year what the inflation rate will be. In other words, how much they're going to decrease the value of your money by per year. Usually it's between 2 and 4%, which in the UK is called the Bank of England base rate. That's published on their website every year. So let's say, for example, the inflation rate is 2% for this year. That means at the beginning of the year, if you have £1,000 saved, at the end of the year, the value of that £1,000 is going to be 2% less. How does that work? So you need, in order to determine how valuable your money is, you need to determine how many goods can I get with this money in the marketplace. And if you can buy 1,000 units of corn with £1,000 at the beginning of the year, and at the end of the year, and the inflation rate is 2%, at the end of the year, you're only going to be able to purchase 998 units of corn with that same £1,000. So the price is going to increase relative to what the inflation rate is. And that's where interest rates come in. Interest rates are charges for loans. So if the bank loans another bank £1,000, the interest rate is going to be the percentage of that £1,000 that's going to be charged to the bank that's borrowing the money. In other words, if bank A loans bank B £1,000 and the interest rate is 2%, the same as the same as inflation. If it's 2%, then that means they have to pay the bank 2% on top of the £1,000 when it returns the £1,000. That could be 2% per year, or it's usually annually, which is the same as inflation. If it's 2% per year, then they usually divide it into months or days, and then they just act accordingly. But interest rates are indirectly proportional to inflation, because inflation erodes the value of your money, and interest increases the value of your money. So if you want to keep your wealth, or if you want to grow it, you need to account for inflation. You need to account for interest, and you need to make sure the interest on your money outweighs the inflation. So if you invest in a project, or if you invest in a company, make sure that after expenses, after expenses and after everything's paid off, the net amount of money, in other words, the money that is that belongs to you after all of the expenses are paid, like taxes, and after you account for inflation, then you need to the percentage yield, or the percentage that you get back outweighs inflation. And that's where the interest rate is so important as a defense against inflation. So yeah, that's pretty much the aim of this video. I just wanted to explain the difference. Also, I'm gonna explain quickly before I end the video. There's two types of interest. There's nominal interest and there's real interest rate. So the nominal interest rate doesn't account for inflation. So it's kind of like accounting for, it's kind of like a gross and net income. Gross income doesn't account for expenses. It's just sales. And net income accounts for is the income after expenses, after taxes are paid, after expenses are paid, after employees are paid, etc. So nominal, that's the nominal interest rate. Nominal interest rates are rates of return based before the inflation rate is accounted for, and the real inflation rate is the inflation rate accounted for inflation. So the real interest rate is accounted for inflation. So take for example the interest rate was 4%. The nominal interest rate will be 4%. If we're looking at the real interest rate, and the inflation rate was 2%, then the real interest rate would be 2%, because you would need to take away the inflation rate, because the inflation takes away from your money. Interest increases your money. So thanks for watching, and I'll see you in the next one.